this conference call is going to be recorded also by Zoom, so that everybody also can then later on listen and view to the presentation. We are absolutely pleased to have you all with us, and we hope that you and your families are doing well. With that, I would not like to lose any time, and I would like to pass on to Carlos to go for the first part. Just 1 second before I forget it. All of you find the presentation on the webpage, on our webpage, s-i-a.ch. On the news section, you find the possibility to download the presentation called Strategic Value Investing. Value and commodities are starting up a new cycle. Carlos?
Okay, please then go ahead with good morning to everybody. Go ahead with the next slide then. This is more or less what we're going to discuss, and this is the first point. You know, we read very, very often, particularly when the markets do not do what the speaker wants them to do, that they're very short-term oriented, that they don't take into account the long-term, etc., etc. Well, that of course has never been true, but this year is a very clear proof that that is not the case. I mean, we've had the worst drop in GDP since World War II, yet the markets are, some are higher, some are more or less flat. And the reason is that markets do look forward, and every sensible investor realizes that although the hit to profits in 2020 has been massive, and it will still be noticeable in 2021 for many companies, the impact on the long term is pretty nil. I mean, the companies that do survive will be back to business in 2-3 years' time, and this is what the share prices reflects, is the long-term discounted cash flows, and those have not changed that much. Now, of course, some industries have been very badly hit. Some companies have gone bankrupt, in fact. Some which have not gone bankrupt have had to issue debt or shares, which means that their long-term value is now lower than it was, because they've had to, you know, invite new shareholders, new owners, give away and give up part of the value of the company. But many, many others are not in that situation, fortunately, and they will recover. Very fast. So we have then to look at two things. What is the short-term impact on the pandemic, which comes down to the issue of where are we, you know, in the pandemic, in the infections, and of course in the vaccinations, and then whether there are going to be some long-term consequences. Now, in spite of everything I just said, we believe that there are going to be very important long-term consequences, and we'll explain to them. So we'll explain them. So we can go ahead to the next slide, which basically says that we are now at the beginning of the end. I mean, this has been a relatively long thing, particularly long when you lived through it. When you compare it to previous pandemics, and of course the latest one being the famous Spanish flu in 1918, this has been short, or is being short. There have been more like 3 years in the past. And of course, if you go to the medieval ages, it was much longer. Now, this has not been that long, although it feels like very long when you go through it. But we're at the beginning of the end anyway. I mean, there are plenty of data now, particularly coming from Israel and now starting from the UK, which are the two countries where most people have gotten vaccinated. So we're starting to have now data in the real world with enormous statistical validity. I mean, now you have like 3 million people, I mean, having received doses now in Israel, and many more everywhere. So what you see here is one of the data we put, but there are many, many things like that coming, particularly in the last few days. The red line is the seriously sick people above 60 years old, and the blue line is seriously sick people below 60 years old in Israel. Israel is an interesting case because you combine two things. You combine a very high degree of vaccination and a not very good follow-up of the lockdown. So you have lots of infections. So you have at the same, so it's easy to separate the effect, the positive effect of the vaccine from the positive effect of the lockdown, because the lockdown is not being well followed for a number of reasons. And what you see is that as soon as vaccinations start kicking in, seriously sick people go down. Vaccinated people, so the ones above 60, which have been the first ones getting vaccinated, well, non-vaccinated people keep getting sick. So the vaccine makes a huge difference. Now, this has already changed because many more people are vaccinated already. I was reading the last data, very interesting. For the last 500 people who got admitted to the hospital, to a hospital, I mean, this was a particular hospital in Tel Aviv, one of them had been vaccinated and the other 499 had not. So it's quite a huge difference. And you see data like that now coming from everywhere. Interestingly also, Israel, for a number of reasons, has a very high prevalence of the British variant of the virus, and the vaccines work anyway. So this is working. And now what's interesting, what you can see in the second next slide, is that, of course, practically all deaths in this pandemic have happened to people above 60. Now, people above 60 years old or 65 in advanced countries, by the way, not so in Israel, but in Europe and the UK, in the US, are about 20% of the population. Now, which is exactly what has been already been vaccinated in, for instance, in the UK, more than that in Israel. And since all countries are starting with the older people, that means that as soon as you get to 20% of the population vaccinated, you have basically all the old people vaccinated, which means that the number of sick people, seriously sick people, which are the ones that are at risk of dying and the ones that clog the hospitals, it's going down very, very fast, which is the case. So you don't need to vaccinate the whole population for the health situation in the country to improve enormously. And we're getting there. Right now, I can go to the next slide. Right now, you have these data are already old because for instance, the US is now vaccinating more than 1.5 million people per day. Now, the US is a big place, but 1.5, it's now 1.6, 1.7 million people per day. It adds up pretty fast because this is cumulative, of course. So China, which of course is in a bigger country, but it is vaccinating now about 2 million people per day. And a few days ago, we had the chart on the right that some of you may have seen. That's a nice way of putting it, that we're getting there. Is that right now, every day, there are more people getting vaccinated than getting sick. So this thing is just obviously flipped around, and that's coming that way. Which all means that in 3 months' time, things will look very, very, very differently. And by the way, nobody really knows, but it seems that, of course, getting out of the harsh winter is also helping. It does help with the typical flu enormously. I mean, people get the flu in the winter, not in the summer. And now we're moving towards the spring. So, and vaccinating people, obviously doctors have learned how to treat sick people, so mortality has gone down, etc., etc. So we have all kinds of reasons to believe that this is indeed the beginning of the end. Now, in the next slide, we can see, what can we expect when this thing is over? Now, a very interesting thing is that this disease has had, from an economic point of view, an enormously different impact on people who are able to work from home, as we do, and people who are not, like a waitress. Now, the first kind of people, most of them have not lost their jobs. Many of the second kind of people have, which of course has all kinds of implications from a point of view of social justice, solidarity, etc. But from an economic point of view, we're in a situation in which personal savings are the highest ever recorded, because we have not been able to spend the money that most of us have kept earning throughout this period. So that obviously announces a huge spending wave when things get out, which, by the way, is what happened after the circumstances were different. Is what happened after 1918. The famous Roaring '20s were due, in a good measure, to the reaction of people finally getting rid of the disease and going back to try to enjoy life. So that is going to happen. So what we are going to have, and Marcos will expand on that, is on the one hand, a cyclical, obviously, recovery, cyclical boom in the economy. But, and we go to the next page, I think what's very interesting is that we're going to have something much more important than that. Because the previous comment was, of course, short-lived. I mean, yeah, we didn't go to the restaurants, and we go more to the restaurants, and that's it. And then everything normalizes after a year. But there is another issue. I put a quote here from, this is at the very end of Keynes' very important book, General Theory, when he says that practical men who believe themselves to be quite exempt from any intellectual influences are usually the slaves of some defunct economist. For the last 50 years, the thinking of what we could, very simplistically call neoclassic economics, which started intellectually in the University of Chicago in the 50s, 60s, and then politically took a huge, of course, impact with Ronald Reagan in the US and Margaret Thatcher in the UK, has been the prevalent thinking in practically everybody's minds in economic terms. Well, that has changed. It's not changing, has changed already. And that is going to have an impact. After 60 years of the idea of austerity, trickle-down economics, if everybody makes money, people down below will also eventually make money, etc. Well, what we have seen is that for the last 50 years, practically all economic growth has accrued to 1% of the population. So that trickle down has not happened, which of course explains much of the populist moves in the electorate, because people are a bit sick of that. And that has changed. Now you can see that for the first time, the European Union, with of course, as usual, Germany at the front, has accepted not only a massive rescue package, but also in a very interesting way, financed jointly. Well, that until now, until this crisis, was absolutely anathema in Germany. And now it has not even been discussed that much. I mean, it's been accepted by everybody. The US is now going for a 1.9 trillion rescue package, which is going to be approved in the next very few weeks. And the big difference with these packages compared to what happened in 2008 is that the money is not going to save financial institutions, which at the end of the day means their shareholders, but it is going directly to the people. Now, a very important thing is that this concept of propensity to consume. If you give $10,000 to a millionaire, well, he's not going to spend more money than before, because he's already spending all the money he wants to spend. If you give $10,000 to somebody who is unemployed and has zero money, he's going to spend them right away because he has to eat. So the impact on economic growth is extremely different. So we're going to see in the next 2, 3, 4, 5 years an acceleration of growth with a big impact on the more industrial and commodity related things, because consumption for the middle and lower classes is much more commodity intensive than for the higher classes. And it's going to have a big impact. And eventually it's going to have a big impact on real interest rates. That is going to take time. There is huge slack in the system until everybody gets back to work. We have several years ahead of us. But we believe that this could have a very important impact on profits. And with this, I'll give the floor to Marcos, but the environment for corporate profits that for the next 5 years has never been better. That is the very, very, very good news. The not so good news is that the market prices of stocks to some extent reflect that. So it's not just, go buy anything. I mean, now we're not the only ones who know this, of course. So that is in prices. And the job of the stock picker has not been abolished because companies are going to make money, because we have to find companies which are going to make money, but where the share prices do not reflect all that and more. And with that, I'll pass it to Marcos. Yeah, we had a smaller slide there at the end that, for years, the obsession, even today, yeah, we can go to the previous slide, Alex. For years, the obsession has been inflation. Everybody's kind of obsessed by the inflation that we saw in the 70s. And everybody's been saying since 2008 that inflation is coming, inflation is coming, inflation is coming, buy gold, buy this, buy that. Well, it's already been 13 years and it has not come. So perhaps if the prediction of a given intellectual model, as Keynes would say, is wrong for 13 years, one should start questioning the validity of the model. So we believe that inflation will eventually accelerate from extremely low levels as it is right now, but we don't think it's going to be a concern in the next 1-2 years. Okay, and with that, I pass it to Marcos.
Thank you, Carlos. Thank you, everybody, for joining this morning to the call. I'm going to start a little bit with our scenario. What do we think is going to happen, which is very, very much related with what Carlos is saying. So basically, we expect a global coordinated recovery after a very short but very deep recession that happened last year, as everybody knows. Basically, why we are so optimistic is based on 4 reasons. First one is that the crisis was one of the shortest duration crises in the last century. And also it has been supported by some measures from the different governments. So it has been a kind of a different crisis from the global financial crisis of 2008 and the previous one. So I think the governments have reacted quite well at this one. The second point is China. China is back to pre-COVID-19 levels. Even flights are back to normal. So really China is back to normal. And also Asia is following a little bit this trend. So this is also very important in terms of global economics. Third point would be that most economies are and will benefit from monetary and fiscal support. And on top of that, we think that some of the large economies will invest in infrastructures and develop large infrastructure plans and energy transition models, which is going to provoke a huge spending. And number 4, obviously, is the vaccines and the medicines rollout that Carlos was commenting out. So basically, we think we have a couple of years very strong growth ahead of us. If you go to the slide number 12, here there's a chart that we have been putting in the last few quarters just to track the pandemic crisis. So this is the industrial cycle. It is a global perspective. And you see very clearly how the industrial cycle bottomed in the second quarter. This coincided with the markets. So, and this is the usual pattern. Normally, the low of the industrial cycle happens at the same time as the market, as the stock market. And now we are back to a more kind of flattish level, which is going to be up and down, probably in the first quarter also, and then starts moving up quite substantially. If we move to the slide number 13, you can see here a different perspective. This is the global GDP growth estimates. It's a chart done by our friends from Goldman. So basically, this is consensus. So GDP estimates for the next 2 years are above trend, ranging between 4 and 7%. For us, it's not very important to have a detailed number. What we try to understand is the trend, and we try to understand the risks. So in the next slide, you can see what is still worrying us, because we are starting an upswing in the cycle, but we're still worried about 3 or 4 things. Number 1, imbalances in China. So there's still structural imbalances in China, both social and economic, but this is a kind of long-term evolution which shouldn't have an impact short-term. The government in China has been able to manage the cycles for the last 2 decades or more. So we are not expecting anything new in the next few years here, but it's something that we need to tackle, or they need to tackle. Number two is the bond bubble, entre guillemets. We have interest rates at zero, close to zero, bond yields at ridiculous level, corporate debts. So at some point, and in line with what Carlos was commenting, if inflation raises even 2-3% in the next 3, 4, 5 years, we don't know, these interest rates should move up and normalize. And this is important for many, many aspects of the economy. Number three, we are starting to see really red flags in valuations. So you see very well technology, you have crazy valuation in some of the names. In credit, you have also very low spreads. Real estate, you have some pockets of overvaluation. And this is a red flag, which is typical of the second part of the up cycle. So we need to watch it and try to avoid them. Again, a couple of things in terms of risk. Short term, we don't forget that we are still in a crisis. So in some countries like Spain, you know, the crisis is deep. So still we need to get out. It's going to take some time. Some sectors are heavily affected, leisure, for instance, and some corporates also. So, you know, we are not out of the woods yet. So we need to be careful. But, you know, everything suggests that we have started the recovery, and it's going to be for the next 2-3 years at least. Longer term, obviously, we need to deal with deficits and debts, and this is another issue, also a long-term structural issue that probably inflation will help to solve. Go to the next slide. I'm going to go down from the macro scenario, which, as we said, is bullish, and to the classic fund. You remember that the classic fund is our flagship. It is a global value fund, and you know, as our recession scenario is materializing, because last year we said that we were expecting a short-lived recession. The classic has performed accordingly. It started the year at 400 euros per share, went down 35-40% to the trough to 250, and now we are back to the pre-COVID levels. So we are quite happy with that because, you know, we met the first investment promise, which is capital preservation. Portfolio has quality. We made really, really few permanent mistakes, and we haven't changed anything. So the main drivers of the portfolio are still there. Now we need to meet the second investment premise, which is a decent return, right? And, you know, we like to think long-term. As you know, the classic has achieved an 8% per annum since inception, 2002, so already 18, 19 years, 11% since the start of the new cycle in 2008. We still think we are in the same, we think we are still in the same cycle, and 7% annual performance over the 5 years. But, you know, having said that, which is not bad, maybe it's not as the Nasdaq, but it's not bad. We think that we need to catch up and reach our target of 10% per annum. I will try to explain why we think we need to catch up. In the next slide, in the 16, basically, you know, the classic has lost some ground in the last 4 or 5 years. Why? Because we've been exposed to value, the value factor, and commodities. Basically, via two drivers, mining via copper and oil. And these two factors have affected us. In terms of what has happened, two of our large exposures have already paid off. So we invested a lot in salmon. We started in 2011 for 8 years, and we sold. So this has paid out, and we're still waiting for another two to pay out, value and energy. So we are setting out a target for this year for the classic of 475 euros per share with a 15% return from current levels. I think the fund is around 420 now. And according to our DCF models, the IRR of the classic is 14%, and the long-term value, let's say 3-4 years ahead, is above 600 euros per share. So we think we have a good performance out there. And if value and energy materializes as we think, we should get there in the next couple of years. Please go to the next slide. Here you can look through the slide 17. You can take a look to the fund look through. So in terms of price to earnings in the left-hand box, we are trading at, the fund is trading at 12.7 times PE versus the MSCI World at almost 17 times, which is relatively cheap. And in terms of book value per share, we are trading at 1.3 times. I choose book value per share because it's easier. Basically, what if I take the companies of the classic, which is basically 30, 35 companies, and I do a quick analysis of converged returns, on average, return on equity of the companies, the weighted average return on equity would be higher than 15%. This means that we should be trading at 2 times book value. If I apply this 2 times book to 320, which is the book value of the whole of the portfolio, we already go to 640 euros per share. And I think we believe that this matches very well with our DCF approach. Please go to the next slide. So very fast, what happened last year? I mean, everybody knows what happened last year. Basically, 3 good sectors: copper, mining, technology, and consumption, just the discretionary part. And basically, in our case, thanks to Pandora, and the worst case sectors were energy, was a disaster, health, pharma, surprisingly was negative, financials, and salmon. So just to mention some name positives were Metso, Prismian, Pandora, ASML, Apple, Viscofan. You can see the performances there. And the copper companies, you know, the basket of copper guys, they made 60% performance last year in our book. On the negative side, I would highlight salmon, which was negative last year. We will comment on that. Energy was a disaster last year. And then some names did very poorly also: ING, Grifols, ISS, Raytheon, Thales. We will comment more later on. What we did is very easy to understand. We sold the winners just a little bit, and we bought the losers because we think that all our companies have quality enough. So we are rebalancing the portfolio. Please go to the next slide, Alex. On the slide 19, I would like to transmit a little bit the exposure of the classic now. 2/3 of the classic is diversified value, which is half of the book, basically. 20% is invested in commodities. Commodities have seen a change. Now 14% is E&P, so oil, basically. And the rest, 6% is in copper. We have reduced the copper exposure because copper last year was up a lot, and we are reaching mid-cycle valuations. And diversified value is a bunch of different names in different sectors, all of them with quality that are very cheap in our opinion. The rest, which is 1/3 of the classic, is GARP, or growth at reasonable prices, where we have, you know, very strong franchises such as MTU Aero Engines, Unilever, Visa, Grifols, etc. Don't remember that we have basically 3-4% weightings per stock, which means that, you know, speaking about 5 stocks, you already speak about 15-20% of the fund. Just a word on the salmon. It was a heavyweight in the classic for 9 years, and we sold almost the full position in 2019 on valuation grounds, and now we are starting to buy back. And by risk categories, very fast, half of the book is in categories 1 and 2, and 45% is in categories 3, which is more cyclical and riskier. We only have 1 company left in categories 4, which is high risk. And basically, we are abandoning the categories for, you know, high risk category, because in the end, you know, it doesn't pay off. In the crisis, you have too much risk. Please go to the next slide, Alex. Okay, here I would like to, you know, what do we have? Just Alex, if you can go back to the exactly. What do we have in the classic? Just as an example, right? This is what we own. We own Devro. It's a leading company in sausage casing, good returns, P 9 times. Thales, leading European defense company, French, very good technology, satellites, ID technology, even in internet, in cybersecurity, P 11 times. ISS, worldwide leader in cleaning, facility management, catering. They employ only 500,000 people. 10% free cash flow yield, PE 12 times. Heidelberg Cement, easy to understand the business, 14% free cash flow yield, PE 8 times 2022. And then Prismian, one of the leading cable companies with huge tailwinds due to the energy transition that nobody mentions, because the energy transition will need cables. And these guys are trading at 15 times, you know. With this, I'm already talking about maybe 15 to 20% of the fund. And you look, this is what we call a strategic value, you know, businesses that are very solid and very decent valuations. We go to the next slide, the slide number 21. This is how we feel, you know. I was showing what we have, and this is what we feel. Everybody is just trying to buy a Tesla or enter into a SPAC. or buy into GameStop into the extreme level, and nobody really cares anymore about modes, free cash flow generation, high returns, valuations, etc. But you know, these markets are always mean reverting, so we think that now is our moment. Please, Alex. Just very fast on what we learned doing an analysis that we always do in December, which is basically on markets and sectors. On markets, equities, as Carlos was mentioning, are fairly valued. The US market is trading 23 times versus historical 19, NASDAQ 30 times versus 25 historical, Europe 18 versus 19 historical, emerging markets are fairly valued. So, you know, we can say that equities are fairly valued now, not mega expensive, but fairly valued. By sectors, the reading is different. There are very expensive sectors. Two are the highlights: technology, 30 times earnings versus average 25, and industrials, which is surprising because it's a cyclical sector, but is discounting the recovery. And key sectors are also very evident, are banks, insurance, financials, and energy. So, you know, to normalize this, what we should see is a 2021 flat market to just, you know, catch up with 2022, and then to be back to the normal performance. But this will never happen. So we'll have a lot of volatility this year also. Interestingly, you know, returns are up a lot on average, and basically are up a lot in technology. And you know, this will also mean revert. I mean that in some sectors, valuation is very high and earnings also are very high. So we will have a double whammy in terms of normalization. We go to the next slide. I wanted to present, you know, the extremes. You look at the technology sector via the MSCI World IT, you know, price to book 2021, 8 times, 7.9 in the first table, historical median 3.6, so it's more than double. And what is worrying, historical high, 10 times price to book, right? So we are really in bubbly territory. And, you know, look at the return on equity, 27% for 2021, 27.5 2022. So we are extrapolating the gains in margins, in returns and growth, where the normal return on equity for this sector over decades is 19, 20, okay? So that's the problem, high valuation and high earnings. Look at the difference with the energy sector, price to book 1.3, historical median 2. I'm not even talking about the high, which is 3 times. We're at 1.3, and look at the returns, 5.7% return on equity next year, which basically will be much higher because Brent prices are going up. But basically what this says is that earnings are depressed and valuations are depressed. So the double whammy here should be up. Please, Alex, if you can move to the next slide. I'm going to go fast to the Natural Resources Fund. It's smaller than the classic, but it's generating a huge interest because of, you know, the thesis that commodities and energy and mining and energy transition is taking shape. So in 2020, it had huge volatility. We all know that this sector is quite high beta. So we started at 100 euro per share. We fell like 50% in March, and now we are back to the almost 100 euros per share. So this means that, again, we've met the first investment premise and capital preservation has been met. So we did the same as in the classic. The intrinsic value of the fund is 150. The fund now is around 90-95. So with a very interesting upside, and IRR on our numbers is 15-16%. Regarding last year performance, it's similar to the classic, but very much concentrated. So mining did very well, and oil did very poorly, which was the main, you know, highlights from last year. What we've done, obviously, is sold a little bit of mining, 6, 7, 8 points, basically copper, and invested more in oil, bringing new companies, and also a bit more in agri-food. In the next slide, in slide 26, sorry, we can see the same look through that we did with the classic. And here it's even more evident that how cheap is this. PE 6.7 times on 2022, price to book 0.7 times 2022. Again, you know, the Standard & Poor's Natural Resources price to book is 1.3. If I use this ratio, the fund should be trading at 175, 180, and it is trading at 90. So, you know, this sector still remains very, very cheap and the cycle, in our opinion, has just started. I'm going to try to comment very briefly on what we think about these commodities on two of them. Then I will pass to Urs on another two of them. Basically, we've been talking for some years, 3, 4, 5 years on supply issues. These supply issues are basically structural. So we have had a decade of underinvestment in commodities. Part of it is now cyclical because the COVID-19 has brought a lot of supply issues. And part of that is from demand because we are going to have a huge support from governments. So the resulting thing has been apparent in 2020 with huge rise in most of the commodity prices now, even with oil recently. And that we realized in the second quarter of last year, or yes, second quarter by the end, we realized that China was back to normal growth, and China consumes more than half of the copper in the world. So, you know, touching our model up, down, what is going to happen with demand supply, we realized that the demand of copper in 2020 was much higher than what everybody was expecting. So, you know, and this has happened. The copper demand last year was positive in the middle of a recession, which was not the initial base case. And copper is very centric for the energy transition. So the next question is, what is going to happen when everybody is back to growth, right? Where is the copper? If we go to the next slide, I'm going to go as fast as I can in copper and then oil. But let's take a look to the IEA estimates of demand of the 4 metals in the next few years. So copper, 30 million in 30 years. So looking from 2020 to 2050, copper double demand from 30 to 60, nickel more than 3 times, cobalt more than 3 times, and zinc double. So we have, you know, a green transition or an energy transition which will be intensive in the consumption of commodities, and demand is going to grow much more than what people think. In the next slide, in the 29, you can see for copper, exactly, for copper, you can see here that in the last decade, copper growth, so if copper, the primary supply is around 20, 22 million, the demand has been growing by 500,000 per year. And the expectations are this demand is going to grow by 1 million in the next 15 years, and even more than that in the next 15 years, and probably this is conservative. If you go to the next slide, you can see the same approach on a different perspective, and it's really easy to justify because it's just the correlation between GDP per capita and annual copper consumption per capita, which is obviously very, very linked. And you see that if you extend this to all the world, all urbanization, all the emerging markets converging to the West, then you'll see that demand of copper will not only reach 60 million, but reach 90 million by the end of the century. And then the problem is in the next slide, in the slide 31. That's the problem. So we need a lot of copper, and this is the supply curve. So we monitor the supply curve, we have all the mines, and there's supply growth until 2023, 2024. After that, there's nothing, not nothing, but we are depleting the reserves, and there's not enough. So we need prices that are going to incentivize new supply. And the problem is that a new mine of copper takes 6, 7, 8 years if you get the license. Let's go fast to oil in the next slide. Basically, it's the same speech, so I'm not going to go very back in detail. Demand, this is basically the range of expectations of demand for oil. So the bear case would be flat demand. If really the EV penetration goes fast, if business goes as usual, then demand can grow by 1 million barrels a day per year. Remember that the base consumption is 100 barrels a day per year. So if we don't change anything, the growth will be 1 per year. If we really move to an EV penetration and the green transition materializes, then we can keep that flat. If we move to the next slide, slide 33, we see the problem. The problem is that since 2013, CapEx is massively down. So we always put CapEx estimates, but I decided to put final investment decisions here, which is the moment where the companies decide to invest. What you can see here is that basically CapEx has halved from the previous decade, and then most of the investment is being done by the majors that now are doing the energy transition. So yesterday Shell said that the production of oil is going to start falling, so they already peaked, And most of the majors are moving to, invest in renewables, invest in solar, in carbon capture, etc. So, this really looks ugly because we will need oil in the next 3, 4, 5, even 10 years. You move to the next slide, you can see a little bit what is going on with inventories, looking at the short term. So since the OPEC decided to cut, we've seen a draw of inventories that has been ongoing since basically the second quarter of last year. We think inventories will normalize by mid-year. And when inventories normalize, prices are around 60, 65. Please go to the next slide. And very fast, this is the conclusion for oil. It's a small table, very easy to understand. Demand, this is December versus December, because a lot of people calculate average for the year that smooths the trend. But here, December to December, demand December 20 was 95. Supply, thanks to OPEC, was 93. So OPEC spare capacity, so they were cutting, is around 8 million barrels a day. And we expect demand to normalize the next 2 years. 2022, we expect 103 million, which is not a massive kind of difference from consensus, which means that the growth in the next 2 years in demand will consume the spare capacity. And then what else? We have a little bit of shale oil at oil 60 minimum because they didn't work with the prices before that, below that. And we need incentive prices and we need companies to start investing, or we will have a supply crunch. It's not something that we see, but there is a scenario where we see prices at triple digit again. So I think I'm done. I'm going to pass it to Urs. Thanks a lot.
Thank you very much, Marcos. So I thought I will have a few words on uranium. As you know, the fund is a diversified commodity fund, and we don't think that shareholders make money just showing a bullish demand curve, because at the end, making money in mining is about mine life, about costs, about scale and grade. And due to this reason, we focus on the best assets you can buy in the world. Therefore, only 2 companies qualify in the uranium space. So we have usually positions between 2 and 4%. Recently, quite well timed, we increased these two exposures. And so some of them will maybe show up as the biggest positions, but probably will never be a sector that goes above 10% of the fund. So some words on this. Uranium is a market which is a product which is only used for 2 purposes, which is nuclear warheads and electricity production. There are around 440 reactors in the world, around 100 in the US, the biggest country with an average age of 38 years. Second biggest is France, 58 reactors. Japan has 50, but only 39 are operable, and only 9 are working at the moment after the Fukushima disaster. China stands now at 50 reactors, Russia 38, Korea 24, and India at 20. So just to name the few biggest one, which makes it a bit a different commodity, for example, in comparison to, let's say, gold, where you have a potential every human being, a customer. So there you only have 440 potential customers. Uranium doesn't have a future because it's forbidden to own, and it provides it provides big part of the base load for many countries. Just some figures: in the US, the power production consists of 38% gas, 23% coal, 20% nuclear. France has a very high nuclear as an exception, 71%. Japan, before Fukushima, it was evenly a third between coal, gas, nuclear, a bit of water. Now they've shifted massively to LNG with huge problems at the moment as they have shortages on imports. And China has now 50 reactors, half of the US. And you can imagine how small, therefore, the share of electricity production is in China. So now, of course, when we talk about energy transition, I could show you a chart which would go up to the ceiling, because it's pretty obvious. If you want to have more electricity, you need to produce more electricity. If you don't want to do it with coal or gas, hydro is virtually saturated. Nothing else is virtually remaining as uranium. my opinion, it's a bit ridiculous to make such projections, let's say like in some other metals, what happens in the year 2050, and then buying some exploration or copper mining companies which have a mine life of 10 years. So in uranium, it's even worse, because if Joe Biden wants to extend the average life of reactors to the year 2069, then I'm going to be 100 years old, and that's 40 years from now. So I don't think it will have an impact, because what we're going to see, it's taking a lot of time until a nuclear power plant is being built. So similar to other commodities, we will see just a little bit of growth for the next 10 years. And this whole discussion about energy transition won't really impact the end use for the next 10 years, because obviously only the nuclear power plants which are under construction will be connected to the grid. And this is around 10% of the existing fleet at the moment. So we can assume a market that is going to grow in end consumption around 1 to 2% for the next 10 years. And if people are following football in Switzerland and know how long it takes to build a football stadium in Zurich, I'm not too optimistic that we will see a lot of new nuclear plants in the next 10 years. So just maybe coming to the next slide, Alex. We see here the historic cycles. So first there was a military demand cycle, beginning of the Cold War, and there was a lot of uranium being produced virtually by the government, and that was mainly going into the defense industry in terms of the huge rise in nuclear warheads. And then the oil shock, which back then we had a much higher part of the electricity production based on oil. Obviously that made it much more expensive. And then we had, as you can see in the years 74, a huge exploration boom in uranium, and the nuclear power plants were being built. And then this was taking over some of the oil electricity production from oil in the 70s. Afterwards, overproduction against the depressed outlook. And then the last cycle started, like many commodity cycles, in the year 2000. Due to China, like everything, obviously China started to build nuclear power plants, consuming uranium, like many other things. Uranium prices went from $4 to $140 on the spot price, and then the cycle ended with oversupply again. And maybe on the next slide, Alex, that's to explain. The market is at the moment, the civil market of uranium is about 200 million pounds of consumption. It's an old slide, but I need to use an old one, because we have to see back what happened, because you see here that actually there was an overproduction until the year 1990, which was a way of storing uranium in nuclear warheads. And then you see the black line, which was virtually the civil consumption, and it crossed in 1990. So we started to deplete global inventories from the 1919 onwards. And what mainly happened is that when the Cold War was over, the world decommissioned their fleets, particularly Russia and the US to a smaller degree. And in Russia, we had the megaton to megawatt project. I mean, it was not a project, it was being forced. So Russia had to decommission part of their fleet. And this uranium went into the civil markets, particularly to the West. This was an obligation for Russia to join the WHO. And therefore, the Western nuclear power plants today run on former nuclear warheads. And this decommissioning and this project ended in 2013. And we roughly consume in the end use roughly a third of the uranium which is being used in nuclear power plants is actually coming from former nuclear warheads. And maybe to the next slide, Alex. So what happened Then we saw that China started to build nuclear power plants, the prices started to rise, and what usually happens, people get afraid of supply when prices are rising, and you saw that uranium is a market where, contrary to many other commodities, is a long-term market. Most of the uranium was traded on 5 years contracts because obviously the usage and the demand is very projectable. And you see a normal market would just contract every year the use. But then in 2005 here, you saw a huge rise in contracting because utilities became afraid of not getting their supply and they started double contracting their annual use. And you have to know, as different to coal or copper or oil, where you can virtually sell the production to every human being, uranium has a very specific end use. And only when you have long-term contracts, somebody will finance a new mine and you will build a new mine. So these long-term contracts were the basis of new mines like Chemical, Cigar Lake, Langer Heinrich, a few others. And then obviously this contracting and this over-contracting, which you saw until 2011, created an oversupply and a huge rise in mine production. And then, as always, you know, there was like overproduction, prices started to fall, and then we had an additional effect of Fukushima, which led to the fact that a lot of the contracted uranium for Japan, which was the second biggest end user, was not used anymore and flew back into the spot market and depressed the spot market to a massive degree with low uranium prices as $18 per pound. And what happens when you have a spot price at 18 and a forward price of 40, nobody obviously is so stupid and buys uranium at 40, so they wait. So the utilities start to wait, not contracting anymore and shifting on the front end of the curve. And therefore now a cycle starts with massive uncovered demand of utilities, which they will have to start buying more and more on the spot market. Now on the next slide, Alex, we see these effects. This is being done on the middle of or the end of 19. So unfortunately, due to COVID, we don't get good data and stuff as we used to have, because companies have other things to do. But we see that we had a lot of production curtailment already before Fukushima. And we have to keep in mind that the production market, 200 million pounds, a third roughly came from stockpiles. So before Fukushima, it was 140 million pounds. And given the spot price too low, the company started to shut production. And let's take some of the best mines like Chemicals, MacArthur River or Cigar Lake. They mine 15% grade, and even these mines were better shut in. So what the company started doing is, instead of producing themselves with a cost of 27, they rather buy it at 20 and provide it into the long-term contract. So meaning actually the producers become spot buyers. Instead of producing, they start buying themselves, which is obviously creating a market with nobody delivering at the spot price, because if even the biggest producers buying, you don't have any material coming to the spot price, and this will be a big problem for the market because utilities will be forced to buy spot more and more in the next decade. And maybe on the next slide, we see what that means for demand supply. Primary production is declining, so we have to keep in mind this market is very small. The US, which consumes most of the uranium, has virtually no production left. It's quite a big issue, by the way, politically, that you depend on Russian, Kazakh and Russian uranium, and you consume most for your energy production. We have mines like BHP's Olympic Dam, which uranium produced as a copper gold byproduct. The big expansion was cut. Ranger in Australia produced 70% of Australian uranium. This is being ending next year forever. And so primary production is shrinking, and we have the same things like Marcus showed in many other commodities, that we have declining production, massive underspending, massive underinvestment, and the demand, which is, in my opinion, not growing massively, but steadily, and probably the risk is rather on the upside given this energy transition. So this is quickly a summary of the uranium market and a little example. I don't know if Marcus wanted to say something, or maybe myself. We don't focus on silver companies, obviously, but silver is a byproduct from copper, gold, zinc, and given the fact that we have the mining companies in gold, in copper, zinc, and obviously nickel, we have a few of the biggest silver producers like Glencore, like others in our portfolio, and it just shows a bit, how, in my opinion, difficult that looks like, this energy transition, when you have an annual production of silver at the moment, 27,000 tons, and it's declining due to the reason Marcus explained in copper. And we have a projection by many people that in 2015 we would need an additional 400,000 tons combined, for the solar panel and energy transition. So this is virtually just simply impossible. And obviously now we have even the effect that some other demand sources, like Reddit and electronics start rising in demand even more. So I think this is going to be difficult and shows a bit how unachievable most of these projections are, given the underspending and problems on the supply side. So thanks. That's from my side, Alex.
Thanks a lot, Urs. I would like to take over here. Basically, looking at the time, we are already approaching 1 hour. Just to repeat, the valuations of the classic fund as well as the natural resources fund are extremely attractive, with a P of 12.7 times 2022 and 3.3% dividend yield and a book value of 1.3. And the same is basically the case for the natural resources fund. Here it's important to mention that the dividend yield of 5.7 is not really due to large European oil companies that have had a high dividend yield. It's really coming from mining companies as well as some oil companies that are rather in the area of the mid caps. Now we have received beforehand 2 questions already by mail. One of the questions was looking at our setup. As you can actually hear, Carlos is sitting in Geneva, Urs is now with me in the office in another room, and Marcos is basically in Madrid. So we have a setup that has been proved already before that we can work remotely. So it's not a problem for us. The second question we got was actually on the salmon exposure for the natural resources fund, which our client actually regards quite a bit of as unique. Marcos, maybe you want to comment on that?
Yeah, sure. Well, we have a long history in salmon, and this sector is a sector that you want to see companies falling. We want to really see prices falling and companies and the stocks falling, because it's a sector which has the same problem as most of the commodities, and the problem is in the supply side. We think that supply is really limited due to a lot of different factors that we're not going to enter in now, but from the situation to the water temperature to regulation, the supply cannot really grow much more than 2, 3, 4% per year in the worldwide, and demand is growing steadily at 6, 7% per year at normal prices. So what has happened is during the COVID, demand of the HoReCa sector, hotels, restaurant, catering, is down a lot in Europe mainly, and also in the US. So demand has gone down, and then the companies have been forced to sell through the supermarkets and retail basically. So demand going down, supply normal, has taken the prices down. So spot prices of salmon going down in 2020, and stock prices going down in 2020. We are buying like hell. So we sold in 19 after position that we stayed there like 8 years. We started in 2011, we sold in 2019 most of the positions on valuation. And last year we started to build up. Now I think it's like 7 or 8% of the classic. As you know, we never go to more than 15%. And this is only in extreme situations. So little by little over this year, we'll build maybe a 10, 12% position in the salmon thing, because, you know, this sector is very, very elastic. Once the economy is back, we will eat everything. We will eat all the salmon that is now in the sea. And once the supply demand normalizes, the long-term structural deficit will be back again. We think the sector is very interesting, and we are back to salmon, very happy to see the stock prices going down.
Thanks a lot, Marcos. Now, if from the audience somebody would like to have a question, maybe there's one question left, you can actually press star number 9, and then I can actually unmute your microphone. That doesn't seem the case, and we are approaching exactly 11 o'clock as we have actually scheduled. Maybe just to end up the situation with the last slide, rather as a joke, you see here 25 years history of computers, 45 years of difference in mobile phones, and 40 years difference actually in the car size. So the only thing that grew quite a bit is actually the car. And what's very interesting here also to mention is the fact that even if it's an electric car, in this case a B, I don't know which number it is, it's going to be using a lot of industrial methods. With that, we would thank you all, and we would like to conclude this call. And please do not hesitate to contact directly by email or by phone if you have any questions on our funds. Have a good day and stay healthy. Take care. Bye. Bye-bye.
Bye.
Infinitivo presente, voz pasiva del verbo capio, capis, capere,